Hi students. So coming to our next topic, tangible non-current assets. So tangible non-current assets. So IAS 16. So in this chapter, we are going to discuss IAS 16 and IAS 40 and IAS 20 and IAS 20. So then first, before going to that, so what is meant by tangible non-current asset? So this was provided in what IAS IAS 60. So generally this standard deals with accounting for property, plant and equipment. Accounting for what? Property, plant and equipment. So generally the property, plant and equipment is a nothing but so it is a tangible asset. It is a tangible asset held by the entity for more than one accounting year. So either for purpose of production of goods or for providing the services or for earning the rental income or for administrative purpose, etc. So it is held by the entity for more than one accounting year for production of goods or for providing the services or for earning the rental income or for administrative purposes, etc. is said to be about property, plant and equipment. So here we are going to discuss the details of these standard, details of these standard. And this standard is not applied. This standard does not apply in some cases. So, non-applicability. So, non-applicability of this standard. So, the first one is assets held for these non-current assets held for resale purpose, and because this is covered under IFRS 5. And another one is biological assets, and this is covered under agriculture. This is covered under agriculture. That is nothing but IAS 41. And another one is exploration and evaluation assets. Exploration and evaluation assets. And this is covered under IFRS 6. And mineral rights and mineral reserves. So mineral rights and mineral reserve. For these cases, this standard is not applied. So because these are covered under another standards, those are covered under another standards. And remember, so this standard is not applied for these items, but any amount spent for construction of these assets, any amount spent for construction of these assets, that is treated as a property, plant and equipment. That is treated as a property. So in the last three cases, like biological asset, exploration or evaluation of assets, mineral rights, mineral resource, etc. In these three cases, any amount spent to construct the non-current asset or for development of the asset for these purposes, that amount spent is treated as per IAS16. Nothing but one property, plant and equipment. So this is what is meant by IAS6 property, plant and equipment and its applicability. So and then coming to the recognition criteria. So generally coming to the in every standard we have to discuss 4 points. One is a recognition, measurement, presentation, and another one is what disclosure. So coming to the recognition criteria. So when an item is recognized on the face of the financial statement, only when it meets the recognition criteria and only when it meets the definition criteria. So as we already discussed, so property, plant and equipment is nothing but it is a tangible asset and held by the entity for a period more than an accounting year and which is used for these purposes is said to be a property, plant and equipment. So for considering an element as a PPE, it has to satisfy generally it has to satisfy two conditions. And before that, in case of recognition, we need to consider what is the initial recognition and what is the subsequent recognition. So initial recognition is nothing but so recognition of the property, plant and equipment at the time of purchase or at the time of construction. So that is count. So initially how to recognize for recognizing an item as a PPE, initially it has to satisfy the two conditions. The first one is it is probable that future economic benefits associated with the asset will flow to the entity. There must be a future economic benefits. There must be a future economic benefits. So, and another one is cost of the asset should be measured reliably. Cost of the asset should be measured reliably. If these two conditions are satisfied, then we consider that item as a property, plant, and equipment. And so here, initially, so coming to the initial recognition, so initially asset is recorded at cost only. So initially asset is recognized. So coming to the recognition, so two types are there: initial recognition and subsequent recognition. Always remember, asset is always recognized at cost initially, but in subsequent it may follow the either cost model or another one is there that is called as what a revaluation model. So then we will discuss those things also. So then coming to the initial measurement. So which items are included in the definition of the cost? Which items are included in the definition of the cost? So generally, cost includes purchase price and all import duties and non-refundable purchase taxes, non-refundable purchase taxes, purchase price and import duties and a non-refundable purchase taxes. Just example, in India, GST is there. In India, GST is there. So that item and another one is cost incurred to bring that asset into useful condition. Cost incurred to bring that asset into useful condition. And one more thing, along with these all things, we have to consider present value of dismantling cost. Present value of dismantling cost. So here, so include all cost involved in bringing the asset into the working condition. And it includes what? Initial cost of capacity, cost of site preparation, development cost, installation, borrowing cost, etc. And coming to the dismantlation cost, the present value of these costs should be capitalized with an equivalent liability setup. With equivalent liability setup. So what is that meaning? So for example, the total purchase price is around $1 lakh, and other cost incurred to bring that amount into the working condition is 25,000, like dismantling, sorry, installation expenses or transportation, etc. Plus, he clearly stated dismantling cost. So after 5 years is around $40,000. $40,000. So here the three amounts are there: 1 lakh, 25, 40. So then coming to the time pattern. So here these amounts, 1 lakh required to be spent at present and 25,000 required to be spent at present. But this 40,000 is required to be spent at the end of the fifth year. This 40,000 required to be spent at the end of the fifth year. Then, while recording the journal entry, so first we have to measure the cost of the respected PPE. For calculating the property, plant, and equipment, you need to bring this amount. This is the future amount, right? This 40,000 is the dismantling cost, which is to be incurred in future. So the first we have to bring this amount to the present. That is called as present value of dismantling cost. Then how to bring? So this 40,000 into 1 by 1 plus r whole power n. So 40,000 into, for example, R is 10%, so whole power 5, whole power 5. Then, so 1 by, so 1.1. So how much? So 0.9090. So this is the amount, 0.683. So 40,000 into 0.683 equal to 27,320. 27,320. So here then we need to bring this amount up. So how much? 27,320. Then what is the total amount? So 1 lakh, 1 lakh, 27,320 plus initial amount, 1 lakh plus 25,000. So 1 lakh 52,320. 1 lakh 52,320. So here these amounts we spent. So these amounts spent in term of the cash, this is to be spent. This is to be spent. But this amount is not going to spend. We have to spend how much amount? 40,000. So then in future, we need to spend 40,000, but the present value of that 40,000 we arrived as a 27,320. So what is that meaning? Every year from this now onwards, if you consider 27,320, then every year we have to consider what element of the interest, and at the end of the fifth year, that amount will become what 40,000. At the end of the fifth year, that amount become what 40,000. So that's why he clearly stated. So while writing the journal entry, we have to consider this element. We have to consider this element, and we have to create this as a liability. We have to create this as a liability. So then, how to record? So how to record? That is the one. So with equivalent liability setup, the meaning it is equivalent liability setup means that one. So how to write the journal entry? How to write the journal entry? So here, so journal entry is when the asset purchase, we have to write debit property, plant and equipment, debit property, plant and equipment, and credit cash account, and credit provision for dismantling costing. So then, so here the total amount 1,52,320. Out of that 1,25,000 amount spent, then 27,320 is going to spend. This is the journal entry. This is the journal entry. Then at the end of the year, at the end of the year, we have to create a finance cost on this 27,320. Then we write debit finance cost account and credit provision for dismantling cost account. So how much amount? 10%. So 27,320 into 10%, 2732. 2732. Then how it become at the end of the first year? The liability will become, so 27,320 plus 2,732. Then how much amount is there? So 3 lakh 52, 30,052. Then at the end of the second year, so 30,000, 305 is added. Then how much amount is there? 33,057. Again third year, so 3,306 is added. Then what is the amount? So 36,360. At the end of the fourth year, 36, 36, 36 is added. How much amount is there? That is nothing but what 40,000. That is nothing but what 40,000. So here we have to add. So 1, 2, 3, 4. So by the end of the fifth year, by the end of the fifth year, so we must have the liability of how much? We must have the liability of how much? So 40,000. We must have the liability of how much? 40,000. So every year we have to charge the finance cost, and that finance cost is created and is transferred to the provision. We have to write in this way. So debit finance cost account, credit provision for dismantling cost account. So this is the journal entry. Okay. So how to calculate the discount by using this formula. So 1 by 1 plus r whole power 10. Okay. Then coming to the first one. So the entity started construction on a building for its own use on 1st April 2007 and incurred the following cost. So purchase of the land. So this is included, stamp duty is included, and legal fees. So legal fees is included, and site preparation and clearance. This is included. Then material, labor, architects, the general overhead. These are all included in the cost. Material costs were greater than anticipated. On investigation, it was found that material costing $10 million had been spoiled and therefore wasted. A further $15 million was incurred on the material as a result of faulty design work. As a result of what? Faulty design work. So how much amount? So here the additional cost incurred due to the wastage. So how much extra amount incurred? 10 million and 15 million. The total 25 million extra, and this is not included. This is not included in the cost. We clearly stated any amount spent, any material is wasted, and any additional amount incurred. So those are not included. Then coming to the labor. And as a result of this problem, work on building ceased for a fortnight during the October, and it was estimated that approximately 9 million labor cost went into this. So means this is also not included. The building was completed on 1st July 2008 and occupied on 1st January 2008. So then which items are included? So this 2,50,000 is included, and this 5,000 is included, and so this 10,000 is included, and this 18,000. And coming to the material, this 25 not included. So how much amount is included? 75,000. And the labor 1,50,000 minus 9,000. So 1,50,000 minus 9 million is divided here. So 1,50,000 minus 9,000. So 1,41,000. Okay. Then architect fee. So 30,000 is generally included. Then general overhead, administrative and general overheads are not included. So then not included. Then what is the amount? So 25,000 plus 2,50,000, 2,50,000 plus 5,000 plus 10,000 plus 18,000 plus 75,000 plus 1,41,000 plus 20,000 equal to 5,19,000. This is the cost. So 5,19,000. So here these amounts are treated as what? Abnormal items. Abnormal due to spoilage or wastage is when it created, and the amount spent due to that spoilage or wastage, those are called as what? Abnormal items, and that abnormal cost is not included. Okay, this is about what? Initial cost. Then coming to the subsequent expenditure. So always remember the subsequent expenditure is also of two types, and we have to verify when the amount spent after purchase of the asset or after bringing that asset into the useful condition, then any amount spent is covered under subsequent expenditure. And only the thing you need to verify whether that amount spent by the party satisfy the recognition criteria as per IAS 16 or not. If it satisfies the recognition criteria, then consider it as a PPE and add it to the cost of the property, plant and equipment. Otherwise, that is treated as a revenue expenditure and is transferred to profit and loss account, a profit and loss statement. So it enhances the economic benefits provided by asset review. So when it is capitalized, subsequent expenditure is capitalized. When it satisfies that recognition criteria, we have two principles. When it provides the future economic benefits to the entity or not, and if the cost is measured reliably. If the cost is measured reliably. and it repairs overhaul and required major inspection of the asset. The cost associated with this is capitalized and depreciated over time for the next overhaul or safety inspection. And it is a replacing component of the complex asset. The replacement component will be derecognized, and the old asset is recognized, and the new asset is recognized. New asset is recognized. All other subsequent expenditure is transferred towards statement of profit and loss, treated as a what revenue expenditure. So, a piece of a machinery has an annual service cost 10,000. During the most recent service, it was decided to replace the part of engineering, meaning that it will work faster and produce more units of product per hour. The cost of replacement is around 20,000. Okay, cost of replacement is around 20. So the amount here, this annual service cost incurred by the party is relating to what maintenance cost, and due to that, no benefits are arrived to the entity. So we transferred to statement of profit and loss. And this 20,000 is the replacement cost, which will generate some additional benefits. So it will work faster and produce more units. So it will generate additional benefits to the entity. So we treated it as a capital expenditure and added to the cost of the respected property, plant and equipment on the face of the balance sheet on asset side under non-current asset. Next, next coming to what depreciation. So generally depreciation in general term, how to define the reduction in the value of an asset, reduction in the value of an asset. So due to physical wear and tear, obsolescence, changes in technology is said to be about depreciation. So, and it is defined as the systematic allocation of the depreciable amount. What is meant by depreciable amount? Depreciable amount is nothing but what? Cost minus scrap value of the asset. So here we have to consider three elements: cost, scrap value, and the useful life of the asset. What is meant by cost? Already we discussed. And scrap value is nothing but the estimated selling price at the end of the useful life of the asset. So called as scrap value. And the useful life, the, the life of the asset over which asset can be utilized. So over its useful life. And depreciable amount is a cost of the asset or other amount substituted for cost plus its residual value. Depreciable, I think it's residual value stands for what? Scrap value. So generally, this depreciation is calculated in three ways. One is what? Straight line method, reducing balance, machine hour statement. In case of straight line method, depreciation is equal to cost minus scrap value by useful life. Here, the depreciation per annum is always constant, and if any percentage is provided, it is always applied on what? Original cost of the asset. Original cost of the asset. And before that, remember the depreciation is always charged from the date when the asset is available for utilization. When the asset is available for utilization. From that date onwards only we have to create for depreciation. Then, second one is the reducing balance method. In this case, depreciation, the fixed percentage is calculated on cost of the asset on the in the year of purchase, and then later it is calculated on what book value. Book value is nothing but what? Cost less provision for depreciation or accumulated depreciation till the date. Coming to the machine hours, so here in case of machine hours rate method, depreciation is calculated based on how many machine hours it works, how many hours it works for producing the good. So in this case, how to calculate the depreciation is calculated as cost less scrap value into number of hours worked by total expected number of hours to be worked. The total expected number of hours to be worked. Okay. Then, so those are the depreciation and how to account for. How to account for. And the depreciation is accounted as, so we have to create debit depreciation, credit provision for depreciation, and we also call it as what accumulated depreciation account. And this depreciation is nominal, so we transfer to P&L. So debit statement of profit and loss account, credit depreciation account at the end of the event. These are the journal entries relating to what depreciation. So these are the three methods. For example, just imagine if in the first year, from the beginning of the year, we follow this straight line method. Suddenly, we want to change the method. Is it possible to change the method of depreciation? Yes, that is possible. And in three cases, when it is permissible on the grounds that new method will give the fair presentation of the financial statement, and it does not constitute any change in accounting policy. And so, first of all, the change in method of depreciation is treated as a change in accounting estimate, not the change in accounting policy. So the change is accepted only when it is meant for fair presentation of the financial statement, fair presentation of the financial statement, and when the change is required by any law for time being imposed, and when the change is required as per IFRS, then in these three cases we can change. Then the change is treated as what? Change in accounting estimation, not the change in accounting policy. In that case, we have to give what? Prospective effect. We have to give what? Prospective effect. So what is the prospective effect, sir? Prospective effect means we have to give the impact of the change from the date of its purchase. We have to give the impact of the change from the date of its purchase, and that is called as what? Prospective effect. So means first, in case of change in method, first we have to calculate what is the book value of the asset on the date of change. Then apply the new method from that day. So if you change from straight line to WDV, then first calculate what is the book value on the date of change and apply the WDV method. Or if WDV is straight line, then apply the straight line method from that. So means that impact of change in method is applied from the date of its purchase, from the date of its purchase. So then, asset cost 1 lakh has an expected useful life of around 10 years. The purchaser intends to use the asset for 6 years, at which point of time, at which point the expected residual value is 40. So that is nothing but 1 lakh minus 40,000 by 10 years. So that equal to what? 6,000 per annum is said to be our depreciation. So here he is asking about depreciable amount. Depreciable amount is nothing but costless scrap value. 1 lakh minus 40,000, nothing but 60,000. And here we already discussed cost, scrap value, and useful life. So remember, these two are estimated figures. So that's why we have to estimate scrap value and the useful life at the end of the every year. Scrap value and the useful life at the end of the every year. We have to review that. So in case of any change, then according to that change, we apply what? Prospective effect. In same way, first we calculate book value on the date of change. Then that will be allotted over remaining useful life of the asset. That will be allotted over remaining useful life of the asset. Then here, entity purchased an asset for 20,000 on 1st January. Straight line depreciation of 5,000 per annum has been charged Assuming a 4-year useful life with no residual value, and the 1st January 2000 expired, nothing but 3 export. And after 2 years, the annual review of assets life was undertaken, and the remaining useful life for this asset was estimated for 4 years. The remaining useful life. So then, how to calculate? First, calculate the book value. First, calculate the book value. So 20,000 by, so straight line depreciation is how much? 5,000 charge, and assuming 4-year useful life with no residual value. So we charge the depreciation for the first year 5,000, for the year 2000 X3, for the year 2000 X4 another 5,000. Total 10,000 is covered. So 20,000 minus 10,000. What is the book value? 10,000 is the book value at X5. 2000 X5. So here we review the asset life for remaining useful life is 4 years. Another 4 years. Remaining useful life of this asset was estimated at 4 years. Then this 10,000 is allotted over remaining useful life. So 10,000 by 4, that equal to what? 2,500 right now. So this is the amount of depreciation for the year 2000 expired. For the year 2000 expired. That is 2,500. 2,500. Okay. Next. So major inspection overhaul cost. So any inspection overall cost general expense. Expense it means revenue expenditure and is transferred to P&L. And so they are however capitalized as non-current asset to the extent if they satisfy. So remember, subsequent expenditure is included in cost of the property, plant and equipment only when it satisfies the recognition criteria. Only when it satisfies the recognition criteria, then only we have to consider. So where this is the case, they are then depreciated over their useful life. That is a count. An entity purchased an aircraft that had an expected useful life of 20 years with no residual value. The aircraft requires substantial overhaul at the end of the years 5, 10, 15. The aircraft 25 million and 5 million of this figure is estimated to be attributable to economic benefits that are restored by the overhaul. In the year X6, the cost of overhaul is estimated to be $6 million. In the year of 6, cost of overhaul is estimated to be $6 million. Calculate annual depreciation charge for the year 125 and the year 62. Then we have to calculate what is the amount of depreciation. So, what is the residual life? 20 years. So, initially we spent the total amount we spent. So, aircraft cost is how much? 25. But 5 million of this figure estimated to be attributable to economic benefits that are restored by what? Overhaul expenses. So here, the aircraft cost is 25 million. So out of 25 million, we spend 20 million at present, and 5 million will attributable economic benefits that are restored by overhaul. That are restored by overhaul. Means that 5 year coming to the overhaul expenditure. So this will provide economic benefits. So out of that 5 million, we have to spend for the year 1 to 5. And at the end of the fifth year, again, you need to spend 6 million. This is from 6 to 10. So means the total three expenditures are there. Initially 25 is required, 20 plus 5 is spent. The six amount is required to be spent from the sixth year onwards. at the end of the 50. So if you consider here the life of this amount is how much? 10 years, sorry, 20 years. So life is 20. This is for 5. This is for 6. Then for the first 5 years, what is the amount? 20 by 20, $1 million plus 5 by 5. 1 to 5 means 5 years, right? So how much? $2 million is the amount of depreciation. But from the sixth year onwards, there is no depreciation on this component. We have the depreciation on this component only. So from the sixth year onwards, we need to provide additional depreciation. Only this amount will continue till the 20 year. Then from the sixth year onwards, what is the amount of depreciation on 20 million? We have the $1 million, right? We have the 20 by 21 plus on the 6 million, 6 by. So the rest of the like overall. So we have to spend how much? 60. We need to calculate what? So 60, 10. Nothing but 6, 7, 8, 9, 10. So how many years are there? 5 years. How many years are there? 5 years. Then what is the amount of depreciation? So that 6 by 5. 6 by 5. So 1.2. Nothing but what? $2.2 million. So year 1 to 5. So overall expenditure is meant for 5 years. So 5 by 5. Then $20 million is spent for 20 years. So total depreciation for the first 5 years, 2 million. And next, aircraft general depreciation, $1 million is continued. Then on this remaining part, overall expenditure 6 million by 5 years. So $1.2 million is the amount of depreciation. Amount of depreciation.